I've been pretty consistent in saying everybody thinks stocks and the metals have to move opposite, or stocks and gold have to move opposite or inverse relationships. And I've consistently said what we're going to see in this last run to the top is that they're all going to play. Stocks are going to play, the metals are going to play, the bonds are going to play. And that's another thing. Everybody saw, the bond market move up when the stock market moves down. I said, no, you're going to have rates coming down. That'll propel the stock market. It'll also propel the metals market. And that's what I think you're seeing. And I think you're going to see it in spades here in a much bigger way in the next few months. I mean, I'm expecting the 10-year to fall to 3% or below in the next 3 to 6 months, probably closer to 3, but I don't know. And the metals, I think my targets could be hit as early as January. $100 on silver, 5,000 on gold, maybe even sooner. If it really gets going here. So I think you're going to see what we've seen in recent months is only going to get more dramatic. And obviously, my stock market call is for this thing to go parabolic and basically vertical.
If the shutdown eventually, whenever that is resolved, one thing I did notice is that almost every single time it resulted in a up day in the market on the day of reopening, almost always. Do you think that when the government does eventually reopen, does that provide a tailwind for the parabolic move up, or again, is that completely disparate?
It probably has more interest to you guys on the trading side. To me, anything it does day to day doesn't matter to me, and it's just whatever it is. I don't think it really matters a lot to the bigger picture. Obviously, if they can never reach an agreement and things start really hitting the fan in terms of people not being able to get food, people not being able to get paid, and their bills aren't being paid, et cetera. Somewhere along the line, if the Democrats are that irrational, all bets are off. But I don't think that's the story. I think we'll see something, probably not until November, which isn't very far away now. But what is different this time is it's usually the Republicans that are shutting the government down, or the Republicans who are trying to have some leverage. And in this case, Democrats have no leverage, and yet this is all they've got in their mind. And maybe they don't care if they mess up the economy because they'll think they're hurting Trump. That's what it feels like to me. Is this is all more of the Trump derangement syndrome type stuff, But in the end, to me, since I don't think it's really holding the market back now, it's hard for me to argue that when they do open up, it's going to have some big effect on the upside.
Yeah, I think that logically flows. With the regional banks, you alluded to it a little bit earlier, but there were two different banks that had dealings with an entity that seemingly is committing fraud to some degree. The regional banks, obviously, really XLF in general, just the entire financial sector, had a pretty big negative reaction to that in anticipation of more widespread. It looks to be contained. But did that reaction mean anything to you? Did the way that the market reacted there highlight anything about positioning, risk tolerance that leads into your broader thesis longer term?
What I would say is that it did no technical damage to the charts. When I look at XLF, when I look at the banking indexes, everything looks fine and bullish. The brokers look bullish, the stockbrokers look bullish. I just don't see on the horizon the warning signs that were there. And this is from the guy that believes next year is going to be all hell breaks loose, but it's just not there yet. There are warning signs. You're seeing subprime auto loans, the delinquency rates are, I think, at all-time highs. You're seeing problems in private credit. They're beginning to see strains, but nothing other. Like you say, what we had that spooked the market really looked like a one-off. It was fraud. It was, a couple banks. It is not systemic at this point. I think we'll move towards systemic, but it's probably still several months away.
I think the point I was alluding to there and wondering if this factors in the fact that the market reacted that negatively to that small of a thing, to me, leads me to believe that when your thesis, if and when it plays out, much bigger gravity, I can only imagine the kind of reaction that that would spur if this small isolated thing caused what it did.
What I think you saw here is, and I view this as bullish, ironically, but what you saw here is how I've been saying for a long time, institutional investors in particular have one foot out the door. They've been nervous all the way up. They never thought this was a bull market coming out of 22. They thought it was a bear market rally. When it went to new highs, they said, yeah, but the valuations are too high for it to have legs. So they've been really behind the eight ball on this all the way up, and they've been nervous about, maybe it's because I've been talking to global bust for several years, but there's enough nervousness out there that they viewed this as confirmation that we're in trouble. There's still a huge wall of worry of people who, institutional investors who think, um, do at least, I think institutional investors think more like my scenario for next year. But certainly the Trump administration isn't thinking that way. Congress isn't seeing that. The Fed isn't seeing that. So the policymakers have nothing like that on their radar. But that doesn't mean the institutions don't. I think, sell side Wall Street doesn't have that on their radar really. But I think there are plenty of institutional portfolio managers who do worry that there's warning signs of something bigger, that we're just so over leveraged, et cetera. So I think what they got from the Zionist thing was something that sparked a confirmation in their mind that, oh yeah, see, we're not far away from this thing all coming undone. But I view that as bullish because that just shows how skittish they still are. How sentiment is still very much on the bearish side. They had to be in the market because they fought it for so long, and then the momentum was killing their performance if they were out. So they're not out, but they're not in there with any kind of bullishness. And that's changing. I mean, they are getting more bullish, but they're just nowhere near what I call the all-in sentiment that you're going to see at the top. And that's probably the biggest reason why I raise my targets. There's just still a huge wall of worry out there.
I see. Yeah, I follow. You had mentioned before, about the global bust, and you definitely have been talking about it for a while, at least since you and I have connected. As the timeline for it shifts, is there a conditional environment that would lead you to no longer believe that the bust is on the horizon?
Yeah, it's not really time driven. I mean, what I've said
Right.
all along is when this cycle ends, it will end in a global bust. A global bust is something we haven't seen in 90 years. So the fact that it stretches and goes a few years beyond in the scheme of 90 years, it's something that rare. It's just not going to be a precise point in time, and there's no deadline on it. There's no what could happen maybe is if the Trump administration's policies really prove so successful that all that money coming in from overseas, investment in this country, getting tariffs to kind of level the playing field in the trade arena. If all those things offset what I think is a coming recession that morphs into a bust, then that's what would change my mind, or that's what would shift the reality of what we get. But I don't have any sense that that's the case yet. I really believe that we are, as I say, it's the huge leverage far beyond 2008-9, far beyond anything we've ever seen in the world before in terms of 330 trillion in debt, quadrillions in notional value of derivatives. That more than anything else is why I think you get a recession that morphs into something far worse. And then you still have under the surface a lot of fragility. I mean, we can look at the fact that, you know, so-called GDP now estimates are at 3.8% for the fourth quarter. I think we're going to go back and predate this period now and say we started the recession before this. That seems insane if you're talking about close to 4% GDP. But under the surface, there's just, again, it's a have and have not economy. And the have nots are at least 50% of the economy, maybe more, or the population, and they are barely getting by. So we're in a period. I mean, it is the Roaring Twenties in a lot of ways. We're in a period where we're not far from, in that case, the Great Depression, and yet it's party on, folks. Everything looks great. That is the similarity. I mean, there are a lot of differences, but that is the similarity, and I think that's the way it goes. Is when you get these events. We saw it in 2008. Right up until, in fact, early September 2008. I can remember distinctly. I was saying hard landing ahead, and financial crisis, and you had all of the street economists, almost all of them, saying no recession in sight, soft landing. And we were a month or less than a month from Lehman Brothers and the ultimate crash. So that is the reality, is that when these things, if it's a financial break, when these things break, they oftentimes come out of nowhere, or at least there's not a lot of pre-warning that everybody sees coming.